Now, this is the first chapter in this module in terms of understanding how we measure in our macroeconomy. And then the first thing we are going to study in terms of measuring our macroeconomy is the size of our economy. Okay. So this is the roadmap of this chapter. Right. So essentially, we are going to focus on GDP. Okay, we are going to understand what is GDP, how we measure in GDP. And then later we are going to look at more detailed concept, which include real versus nominal. Okay, and then so there is going to link to price index or inflation. But essentially, so this chapter we focus on measuring the size of our economy. All right, so that's the big picture. So why we care about this? Because usually, so you may come up with questions like, how do you measure in the economy, or how you compare economy A versus economy B, right? Like a while ago, 2010. So there's headline news says China passed Japan as the second largest economy. And usually people will say, okay, so US is the largest economy. What does that mean? Right? Or in other words, how we compare one versus the other. Right? And then the answer is we are going to comparing the value of their production. So then here, so there are two keywords. Number one is their production. And the number two is the value. Okay, so value of production. Right, so how much they can produce, and then what is the market value of whatsoever they produced. And then so we use this number to compare Japan versus United States versus Mexico. Okay, so that's the way we do business, right? But then so GDP is the most studied items, or the most prominent items in terms of comparing the economy versus economy, or to calculate the value of production, right? So now we need to understand what is GDP. So on top of GDP, or kind of background of GDP, so GDP is part of national accounts. Okay, national accounts. So in some sense, this is a accounting system. Okay, I know some students has accounting background. So we have accounting system to measuring some business or corporations economic activity, right? So you have accounting. But then so here, similarly, we have accounting for national economy, right? And so this is called national income and product account, or sometimes short for NIPA. So this NIPA, or national income and product account, was designed to measure a nation's economic performance. But here, so you may think this in a more general way, in the sense, so when we say we measure one nation's economic performance, so this can be substitute, or this can use to measure in, say, a city, a province, a state, or even a continent, right? So the nation is not the final word. It just says, okay, we can use this accounting system to measure in some economy, and this economy can be an economy of a village, the economy of city, the economy of state. Okay, but usually we talk about the economy for a country, right? And then so with this NIPA account, we can do at least two things. We comparing one versus the other. Okay, and secondly, we can track the economy throughout business cycle. Or in other words, so here, so this one is at the same time. This is across border. And this one, this over time. Right, so this is at the same time, this is cross border. We compare country A versus country B. And the other one, just look at the same country over time, how you did. Like I remember in the previous lecture, so we study economic growth. We look at the US economy from 1900 to 2010. We saw there was tremendous growth. The way we measure the growth, or the way we keep track of the growth, is by looking at GDP, right? So you can see the importance of GDP. Now, before we understand how to precisely measure GDP, and then we have to study a few concepts, and these concepts help us to understand. This is to help us understand how the macroeconomy works, and it actually is how the macroeconomy work in the abstract, stylized, tractable way, so that we can calculate or we can keep track of our complex economy. Now, just imagine if we ask to calculate the value of production, not to mention United States, say the value of production of Omaha. Just imagine how many people live here, how many economic transactions happens, how many type of goods and services were produced. It's very complex. Okay, and then so we need to simplify, right? And we need to do something trackable. Okay, we need to do some characterization, so then we can easily track what happens on a daily basis or annual basis. Okay, and then the following few slides is going to serve as that purpose. We introduce some concept so we can see through those complex reality. Okay, first, consumer spending. Okay, so this household spending on goods and service. But what is goods and what is service? So goods usually something tangible, right? So for example, so the iPhone I use and the computer I use for the presentation. So those are tangible. But service, what is service? Usually is intangible. Just to give you an example, the lecture I'm giving, that's service, right? So you do some volunteer work, so that's a service. Hey. Consumer spending is what households or typical American households spend on goods and service, right? Second concept, stock. So this is a share in the ownership of a company. So for example, if you ever invest in Apple, or if you buy a share of Google or Metaverse, right? So that's stock. Okay, so that just show, that's a proof you own a small fraction of a entity or legal entity, right? So next one, bond. Bond essentially is a IOU, right? So this is borrowing in the form of IOU. So here, IOU, I owe you, so means, so I owe you some money, or I have some obligations to you, right? So this is bond. That is essentially, it's just borrowing note. And the next one, oh, by the way, it's a stock and a bond. So it's important concept here, because that's going to show the financial transaction happens in our macroeconomy. The next one is government transfer. So government transfer is a payment from the government to individual. But let's keep in mind, no goods or service is provided. Give you two examples. If the city of Omaha, so they decide to hire someone to fix the road, so that's not transfer. Actually, this is public spending. Okay, because so the city of Omaha give you money, and as a return, you must fix the road. Okay, now what is transfer? So during the pandemic, the federal government sent majority of us a check, right? So that's transfer. Because when the federal government send you the check, there's nothing required you to return. Okay, so that's the difference. Next one, disposable income. disposable means so you are free to spend. Okay, everything is under your control. Okay, what is disposable income? So this is your income. Usually, so we have income coming from wage, or someone may have capital income, meaning you make money by investing in stocks, or someone may have income from property. Okay, anyway, so those are your income. So income, but usually we must pay tax. This is something you cannot avoid, right? And then, so you may have a transfer. Okay, example, 2020 and 2021, the federal government sent everyone a free check. Okay, quote unquote check free. As we are going to see later when we talk about fiscal policy, toward the end of the semester, you will understand nothing is free. But in macroeconomics, we already knew, right? So nothing comes free. The same here. Okay, but anyway, so the government give you a check, so that's transfer. You need to consider that part of your disposable income. But first, you have to pay your tax. So your income minus tax plus transfer. So that's everything ready for you to spend. So this is called disposable income. Right. All right, so now we are ready to look at our macro economy. So we are going to use a bird's eye view. Okay, we are going to kind of fly very high above the earth, and let's look at our macro economy. Okay, and then the first thing is we are going to do something very abstract. Right, very, very abstract. You just think about the concept model we have talked about earlier. So we are going to characterize everybody in two things. You either a household, or alternatively, you are a firm. What's the difference? From the name, households essentially is what? So they consume, right? And the firm, what they do, they produce, right? But then you may wondering, so in order to consume, how are you going to pay for your consumption? So that's the question. So in some sense, that's how these two things are linked together, because nothing are isolated. So that's the point. Macroeconomics. So everyone are connected and intrinsically connected. Right? So households, in order to consume, how they can pay for their consumption in this simple framework. Okay, let me repeat what I said. Okay, so we are going to simplify our complex economy by saying the following. So regardless who you are either a household or a firm. Now the next question is, so households, yes, they do the consumption, they buy goods and service. Where the money, where the resource coming from? On the other hand, as a firm, they produce. Yes, that's true. They do the production, but how they can make sure the machines start to run? Okay, so the answer is, so the households, so they are going to buy goods at here, right? So this market for goods and service, you think about, so you buy goods and service, you buy stuff on Amazon or in Target or Walmart, okay? But then so households, in order to afford those goods and service they want to consume, so they are going to sell something in the other market. We call it factor market. But what is factor market? What do you think? So what you can sell as households? Yourself, that exactly yourself. But exactly, so what you are selling yourself? You're selling your labor, right? So you sell your labor to firms like we work. Okay. Not only we sell our labor, sometimes you have money, you have saving, right? You can rent your saving to the firm, right? But sometimes there's an intermediary, so we simplify. Okay. So basically, to summarize, So where we start, so there are only households or firms, they interact. They interact in two markets. Households is going to spend or purchase goods and service in this market. Okay. And if we can keep track all of those spending, and we should immediately have the first measure of GDP. Why is that? Why is that? Because nothing will waste it, right? So everything produced must put on the market for sale. Because remember, okay, so we start from very simple, okay? At the moment, there are a few things I want to emphasize, probably I forgot to emphasize. At the moment, there's no international trade. Okay, so we kind of live in the island, but we are going to relax that or add those features later. For now, we live in the island. So everything we can produce is going to happen inside here. Because we live in the island, and everything we produce must put on sale in this market, right? And then everything on sale eventually will be purchased by someone. That's households. Now, if we keep track of all the consumer spending, that should immediately give you a measure of the total goods and the service we produced. Does it make sense? Because we know closed economy, right? So this is the first. Now, next step, the firm, in order to produce, so they must use some inputs, right? And what input they need for firm to produce? So they hire labor, right? Let me write down. So they need higher labor. And then sometimes they need capital. What else? They may need land, building, right? So usually that's what we need to do a business. Okay, but then so if you use those resources, you must pay for the use of those resources, right? And then so the labor, you need to pay wage. Capital, you need to pay interest. Land and the building, you need to pay rent, right? And then finally, you have some profit. But profit goes to where? Because remember, so firm is just a legal entity. And eventually firm is going to be owned by someone, right? Means firm must owned by someone here. So actually those are the actual person, right? The firm just legal entity. Okay, regardless how complex is a corporate structure, eventually it must owned by someone, meaning so the profit eventually will go back to households through this factor market. But again, what is factor market? So that's the place where firm to acquire the following things so that they can operate, including labor, including capital, including land and a building, right? Once they acquire those things, they must pay the cost, okay? And all the cost is going to exhaust all their value. Does that make sense? In accounting terms, yes, they're going to have some profit, but in economic terms, profit will go back to whoever owns the firm, right? But eventually, its firms must owned by human being, which is households. You hear, right? So everything's go back here. Now, from this discussion, what are we going to realize? We are going to realize another interesting thing. Okay? So if we keep track all the income Those are the income, right? So this is the income from the standpoint of view of households, right? Because households, what? So they are going to sell, in some sense, sell, quote unquote, sell their labor, right? And the household is going to rent out their capital. Household is going to rent out their land, right? And in some sense, household is going to buy stocks or own a small fraction of the firm. So eventually, all the income will go back to households. But the income essentially reflects what? Or income, where does income come from? Coming from the sales of the goods, right? To summarize, so we have learned two things, but immediately means three things. So we can look at the market for goods and the service, and then so we can look at the spending. All the spending will give you a value of GDP. Why? Because this will close the economy. Whatever you produced eventually will be purchased or consumed by someone. Number one. Number two, all the revenue or the money the firm received by selling goods in the market eventually will return to whoever owns those resources, right? So this means if we keep track of the income, this income. So we are going to give another measure of our GDP. This must equal to each other, right? Because again, so GDP is what? Is a value of production. But all the money you generate by sell your production must return to the owner of those resources, right? So or show up as income. So this second. Now, finally, so if we look at what happened inside the firm itself, we are going to have a measure of the production. Actually, that's the definition of GDP, as you're going to see later, right? So that just means, okay, so we can look at the measurement of GDP through three different channels or three different angles. Okay, what are those three different angles? Let me summarize. Angle number one, we look at market for goods and service, spending. Angle number two, factor market, income. Angle number three, actually, that's the most intuitive and the most natural one. So we look at the firm itself. So that's product. Okay, so we can look at the measurement of GDP through three different angles or three different approach. Those three, by construction, they should give us the same exact number. Okay, we will have examples show up later. Okay, so now we have a rough idea how to measure in the macroeconomy, right? It's one sentence to summarize. Basically, we can look at either through spending or through income or through production itself, right? But this is in a very simple framework. In the sense, no import and export. But this is not what happens in reality, right? But however, so the most immediate things we need to add into this picture is not import and export. Because actually it's import and export. If you look at human history, it came up much later than something more important in this picture. What do you think is missing from this discussion? Besides import and export, think about our economy. What is missing? Government. Okay, that's an excellent answer. Okay, so now immediately I'm going to introduce or incorporate the government into this picture and see how that changed the calculation. Okay. Government. What government does? Government provides goods and service, right? What type of goods and service usually government provides? So we are in a public university, right? So in some sense, lots of goods and service so was provided by the government implicitly, Right? So, for example, so the tuition we paid is much lower than Creighton. So in that sense, so the government provides part of the service. Does it make sense? Okay, we can have a whole discussion, but here just simply just give you a quick idea what government does. So government in some sense, in a simple way, so government is going to do the following. So they collect tax, that's their income, and use their tax or use their income. They also purchase goods and service. Okay. Use higher education as example. Like just follow up with the example I just gave to you. Like we are public university, Creighton is a private university. So in some sense, in a very crude way, so the government is going to compete with private sector to what? To purchase service from professor, right? And so private sector like Creighton's, right? Creighton, they also hire professors. Then they just for profit, right? Like households, in some sense, Creighton's, you can in this way, so you can just put Creighton inside here, and so you can, in a very crude way. So you know it's a part of the government because we are state university, right? But both UNO and Creighton, they hire professors to deliver lectures, to provide service, right? Does it make sense? Okay, and then so in some sense, here's a firm, like you think about those are professors, right? Each individual professors, they are producing knowledge or lecture, right? But then so one probably just goes to like here Creighton, the other just goes to UNO. So that's in a crude way, right? So for the government, their income comes from tax, okay? But not only they use the income to purchase goods and service, sometimes they give households transfer. Like I just give like the example is give to 2020, 2021. So there's a federal free check for everyone, but again, quote unquote, not free. And the other example of transfer including Social Security. Okay, if you ever heard about Medicaid, so that's also a transfer, right? If everyone ever heard about food stamp, okay, so that's transfer, right? And there are many other type of government transfer program, like food stamp, Medicaid. So there's no return required from the recipient, right? Okay, so this is government. So now let's see so how the introduction of government changes the calculation. So remember, so we talked about three approach, right? Approach number one, we look at the production. Number two, we look at spending. Number three, we look at income. Let's start with the simplest one, production. Does the introduction of government change the way we look at production? Not really, right? Except so government has their own production, right? But usually it's when you simplify, usually we just say, okay, the government just purchase good service, like including meter. Okay, so there's no impact on production. What about spending? So now you can see when we look at spending, not only we need to look at consumer spending, we also need to look at government purchase goods and service, right? Okay, so now final income. So income really there's no impact, okay? But however, later we must be careful. As the example show off, sometimes people say, okay, or student says, okay, so isn't that tax as part of income of the government? Yes, it is. But when you calculate GDP, if you add tax as income, and then so you're going to enter double counting. Why? Because where the tax coming from households or coming from households income, right? So meaning, so either you just look at households income only, or if you say so tax is part of government income, and then you must subtract tax from households income. All right. So now this is the second part. So we just add government into the discussion. Okay. So now what are we going to do next? So we are going to introduce a financial market. And why we need to introduce financial market? This is because usually, so there's borrowing, right? Not only households borrow, and also the government borrow, right? So why government borrow? It could be the case. So each peer, their income cannot is not enough to pay for the purchase of goods and the government transfer, right? So this can happen. Right? Now, with the help of the financial market, and then the government can borrow from the financial market, and similarly, firm can borrow. But then, so you may be wondering, so where the money coming from? Where the money of the financial market originally come from? Where the bank's money come from? Household saving, that's the excellent answer, okay? So essentially, right, so this is a source saving that we know where the money coming from. So first, the money may flow to government borrow, okay? But then, so the resource coming from private saving, okay, household saving, okay? Not only government borrow, sometimes firm, not sometimes, usually firms, they also borrow, right? So they borrow, and then, so why they need to borrow? And usually, so firm, they may want to expand their business. They are going to have some investment spending. What does that means? Like say in the CBS, so we have expansion for our building, right? So that's investment spending, right? Okay, now let's see again. So how this change the calculation? How this change the calculation? Okay, so we have a free approach, right? Let me write down. So first is spending. Then product. And then it's income. How would the introduction of financial market change the calculation we have just talked about? Start with simple one. Is there any impact on in product? No. What about income? Also no impact, right? Because again, so this is flow to here, right? So no change on income. The only impact on spending. Now, not only we need to track consumer spending, government spending, we also need to track investment spending. Meaning, so the goods and the service produced will not only consumed by consumer, government also consume fraction, and finally, other business may also consume a fraction. It's like say, for example, a computer, okay? Not only computer purchased by households, it may also purchased by government, and it may also purchased by other firms, right? So, and then so you need to keep track all the purchase among three different parties. So this is the introduction of financial market, right? So now we go to the last step to finish our picture. Okay. We are going to include rest of world or other countries. So essentially, we are going to introduce import and export, right? So now let's see what happened. So export means rest of the world is going to purchase goods and services we produced, right? So this arrow means, so there's a demand. So this arrow just means there's a demand for goods and services we produced from rest of the world. But some at the same times we have import, meaning so we have demand for goods and services produced by other countries. Like we import avocado from Mexico. We import car from Japan, right? Or we import some machinery from Germany. We import oil from Saudi Arabia. We import wine from France, right? So this list can go on and on, right? So those are import, right? So, but then to finally close these slides, there's one thing is missing. Like we discussed in previous lecture. So usually there's imbalance in international trade, meaning usually so the import doesn't equal to export. Does anyone remember what is the trade balance for the United States? Usually, do we run a trade surplus or deficit? Deficit, meaning we import more than we export. Okay, but then so how we can pay for those large sum of deficit, meaning so if we want to import a lot of wines from Europe, but we don't have enough export, how are we going to pay for that import? What do you think? Borrow. Excellent. So that just means we are going to borrow from financial market. That's close, right? But this borrow is like two-way. So sometimes if we run a deficit, we have demand to foreign credit. If we talk about Germany, so they have surplus, and that means so they are going to have saving, right? Okay, so that's going to close this discussion. But similarly, so if we look at three different approach, so the introduction of rest of the world, you should only change one thing, which is spending. So now we can see, so if we let's just focus on spending, okay? Let's focus on spending. So now we can see not only we have the original consumer spending, and then so secondly, we add government. Now third, we introduce investment spending. Finally, we need to get a net export, right? Because we have demand from outside, but we also have demand to outside, right? So we need to subscribe. We need to get net demand from our goods and market. Sorry, our goods and service. So we just add these four. So as you're going to see later, so this is called C plus G plus I plus NX. Okay, C goes here, G goes here, I goes here, and NX goes here. All right. So this is how we measure in our macroeconomy. So this just give you a bird's eye view, right? So now we can move to a few concepts. This is largely, those concepts are largely repeat what we just discussed, or just kind of summarize what we just discussed. Okay. First, private saving. So it's because households usually they don't spend all of their disposable income. And then, so there's private saving. Disposable income minus consumer spending. Right? Second, financial market. So the financial market includes banking, stock, and the bond market. Okay. So the financial market works as a middleman. So essentially, they are going to connect those who have and those who have not. All right. So this is just a middleman, the channel through the money from those who owns to those who need. Okay. So this is financial market. And the government. So we have talked about the government transfer. Now here, so we are going to study government purchase of goods and service. So that's a total expenditure made by federal, state, and local government on different goods and service. It can be tangible, and it can also be intangible, right? So sometimes government may not have enough money to pay for their purchase of goods and service. They may even short of the money to pay for the transfer or the current transfer, to be precise. Okay, and then they are going to have borrow. The government borrow is the total amount of fund borrowed by different level of government in financial market. Right, so this is government. Export and import. Okay, so essentially that just the flow of goods through international trade. Right, so export is goods sold to other countries, and import is goods purchased from other countries. Right, so we have plenty of examples, and just keep in mind, usually US is running a trade deficit. Okay. Now, next two concepts, inventory. So we haven't talked about inventory yet. Let me just start with a simpler one, investment spending. Investment spending are spendings on productive physical capital. Example, machines, right? Construction of new structures. Like say, if was a CBS, so we have a new win. So that's investment, okay? And finally, I want to emphasize, if there's a change to inventory, this also considered as inventory, investment. But what is inventory? Inventory in terms of definition, that's the stocks of goods and the raw material held to facilitate business operation. What that means? So for example, we go to Target. So they have their warehouse, right? So why they need to have so much goods in their warehouse? Because they need to satisfy the demand. And this demand is come out randomly. And plus usually takes time to get the good from the factory to their shelves, right? And those things is called inventory. But inventory sometimes can run low, sometimes can run high, right? And or in other words, there's a change in inventory. So for example, if they get a lot of goods, right? But the demand is weak, and then they add up this is called the add up inventory. For the added up inventory, what do you think they are going to do? For the good they cannot sell, are they going to destroy them? No. So what they can do? They're just going to stay there for next sale, or either way. So some students think about just reduce the price to sell. But the same thing, my point is, so they're not going to destroy them. So they're going to hold them in their warehouse and wait for the next day or next season, right? And so in a very crude way, you can think that as, so they just purchase the unsold goods from themselves and then for next period. So that's why we characterize inventory change as investment, right? So now we are ready to look at the definition of GDP. So GDP is defined as following. Okay? It is a market value of all final goods and services produced within a country in a year. So there are a few things. So let me just break down this concept. Okay. Start with simple one. It's within a year, meaning there's a time frame. Within a country, meaning, so there's a geographic restriction. Okay. And then so all final goods and the service. So we will see that what that means. Okay. But just keep in mind it's final goods. Lastly, market value. Meaning we need to put a price on that. Right? So there are 4 things. Okay. So let me write down 1, 2, 3, 4. Okay. Market value, meaning so we need to put a price because we need some apple and orange. Okay. Final good and service. I'm going to explain to you what does final means. Within a country, in a year. Within a country, meaning this is a geographic notion. But in history, we use something slightly different. Okay. I mean, in terms of measuring the size of economy. So before we use GMP. And here we use GDP. D stands for domestic. And in previously, so we use GMP, that stands for gross national product. Okay. Now this is a definition. So this definition, so we can calculate the GDP by looking at 3 different ways. So this just follow what we have discussed earlier, right? So I use this simple graph or simple diagram, flow chart diagram to explain how we can look at our macroeconomy. Okay, what are those 3 approaches? First, we can look at the total value produced. Again, so I still need to explain to you what does final means. Okay, just don't worry. So I promise you I will explain to you what that means. But here, so another keyword is produced. So this is the first one. So corresponds to the diagram we saw earlier. That just means we focus on firms. Next, we focus on spending. But remember, these are spending on domestically produced. All right, but again, so final goods. Third, income. Okay, add up the total factor income earned by households from firms in the economy. And this usually this income show up as the following, which interest, rent, profit. Okay, maybe it's a profit. I could put a parenthesis called dividend. So wage is paid for the use of labor. Interest is paid for the use of capital. Rent is paid for the use of building, land. Profit and the dividend, that is paid for the ownership of the business. So those things should exhaust all your income. Right, but then eventually income will go to households because that's who own the economy collectively. Right, so there are 3 approaches, and from the discussion you should realize, so they must equal to each other. Right, 3 different approach. Okay. Now here, this slide kind of explain to you why they are equal to each other, and particularly spending equal to income, income equal to spending. Just use this background picture, right? So basically it just says every penny I spend becomes somebody else's income. Where any penny I spend becomes somebody else's income. All right. Someone may say, okay, so what happened? So I received $10 as the income, but I lost my money. How we interpret it, how we are going to consider that, or how we are going to calculate that. So usually you probably just consider that as consumption. Okay, so here's your income, but you just lost is the consumption. The other example can be, okay, someone say, okay, so if I have income and then I'll donate, what happens? That's also part of the spending, right? So let's run a few slides, kind of emphasize or trying to better understand what does GDP means. Okay, it is produced, meaning it's going to measure in production. Furthermore, it implies we should not include used goods. The sale of used goods, right? Because the used goods are not produced in current period, but used goods must include it in the GDP of the year it was produced. And accordingly, sales of financial assets are not included as GDP. Because the sales of the financial assets only show you the swap hands of the ownership. It itself doesn't generate any real goods and service, right? Nevertheless, I want to emphasize, so even though used goods not included, sales of financial assets not included, but in reality, or even in this theoretical framework, so there are service associated with the transaction. Okay, meaning, so for example, you sell a house was built 20 years ago, so you need hire an agent. Okay, say for example, so Elon Musk is trying to acquire Twitter, and he hired lawyers or financial analysts, right? And it's, so those are service. So those will consider as GDP of the current year. Is that clear? So these two different things. Like in the first example, the house, the value of the house will not include in this year, but the service the agent provide, okay, usually show up as the commission fee, right? Like I said in the first class, probably like 6%. Is that correct? Okay, so this 6%, that is the value created by the agent. And another example, Twitter. Okay, so then if Elon Musk decide to acquire Twitter at 5 billion, so this 5 billion won't consider as this year's GDP, because Twitter was created decades ago, right? But however, if Elon Musk hire lawyers and pay the lawyers, say for example, 100 million, and this 100 million is going to reflect the service provided by the lawyers. So that is part of 2022 GDP. Is it clear? Okay, so let's keep that in mind. So this is the first one. GDP is within a country. Okay. But I want to say, so this within a country, this is like, usually we say that, but in certainty you can say, okay, so within the city, within the boundary of a village, right? So this can be simply can change depending on the scope of the question you are looking into. But here, so the important thing is to understand two examples. Example number one, cars produced in Mexico by American firm. It goes to Mexican's GDP because the production happens inside of Mexico. Even though eventually, so this profit goes belongs to American. Okay, another example. Cars produced in the United States by Japanese firm. It will include in the US GDP. All right. So this is GDP. So this is like a domestically, or there's a geographic restriction because inside the boundary of the economy, right? Now let's look at the practice questions, kind of consolidate what we have learned. Question asks you, are the following included in the US GDP? First, price paid by a German when staying at a New York hotel. Is this part of US GDP or not? It is, right? Because the service was produced or was provided at the US, right? So yes. Second, the price paid by American tourists when staying in Berlin hotel. No, so the transaction or production happens in Berlin. That's not part of US territory, right? So answer is C. Clear? Okay, so it's domestic. Now, furthermore, so GDP is in the year. But again, so we are feel free to say, okay, so within the quarter, within the month. Okay, but then usually we don't say like within a day. Usually we use look at year or quarterly. That's what we use, right? So maybe let's see so whether this link works or not. So we can look at the current, right? So look at this website, the Bureau of Economic Analysis. That's the government agency in the US responsible to collect data and then compile the data to produce the precise measure of GDP. And they report this on a quarterly basis. Like the most recent one, so they have second quarter. The third quarter is coming up because third quarter has not finished yet, right? And so if you're interested, you can click their current release. And but here, maybe we can look at this one to look at the trend. Right, but this is a quarterly US current account and component, essentially just show you, so the trade surplus and deficit, right? So it's back. And then what else we can look at it? So yeah, so the current release, let's see, is there any picture we have or not? Yeah, this current account, okay, so current account, it just tells you the import and export, right? Look at it here. So you have import of goods and export of goods, right? Now, what else? Let's see something. So that's good. So anyway, so let's back to our slides. Okay. To summarize, those are the things you need to be aware of or pay attention. What is and what is not. So this is essentially the definition, right? But here I want to emphasize change of inventory, new construction of structures, okay, capital goods, and particularly change in inventory. So this is something you need to keep in mind, right? We will come back to that later. Okay, actually, the change to inventory is a very important indicator to understand the health of our economy. It's very simple, okay? Just say, for example, so if you have a small business and you find out you start to pile up inventory, do you think the economy is doing well or very bad? Or in other words, do you think the economy is a strong demand or weak demand? I'm sorry? Weak demand. Right, so if you start to pile up inventory, means people don't want to buy your stuff, right? So and then in terms of aggregate economy, so if we see an increase in change in inventory, meaning so the demand is weak, so the economy is in the trouble. All right. So we will get that point later. But here just keep in mind, so change to inventory is part of GDP. And usually it's characterized as investment. Very simple. I'll give you another example. Apple or even any cell phone makers, usually they need to project the sales and then they make lots of cell phones before the announcement, right? Because they make sure so people can get a hold of their phone, right? But however, if they overestimate, that just means they are going to add a lot of inventory in their warehouse, right? Are they going to destroy? No. So they are going to put in the warehouse and then change their strategy and eventually going to sell them, right? But then, so equivalent, you can think about it. So what happens is Apple is going to purchase those unsold from themselves for next period. Does it make sense? Okay, so that's why we characterize this as an investment. Oh, sorry. So we haven't finished yet. What are not included? Intermediate goods and service. So what is intermediate goods? So we haven't talked about that yet, but we have slides show that. So just give you example. So the computer I use, there's a CPU inside. Okay. And this CPU goes to this computer and the computer sells to me and everything goes to final. But if the same CPU was sold by Intel to Apple, okay, and then so this CPU is intermediate goods. Why is because eventually, so the Apple is going to use the Intel CPU to put in their MacBook and sell to the final customer. So if we just if we include the CPU's value in the GDP, we're going to have double counting, right? Let me write down. Okay, so say for example, there's a CPU goes to Apple, Mac, and the Mac goes to the households. I'm saying, so if you just include this as part of GDP, and then so you're going to have a double counting. Why? Because now this, say for example, this is like $100, right? And but then remember, so Apple, Mac, there's a CPU inside. And somehow, so there's another $100 in the cost of this MacBook. Does that make sense? So that just means you're going to calculate this value of CPU twice. Does that make sense? Okay, so this is called intermediate goods. Okay, so you cannot include the intermediate goods. Otherwise, you're going to count it twice. Input similar to intermediate goods because it's going to be put to produce something else, right? User goods is come from previous year. Financial assets, it's just a contract. It's just a legal document shows the ownership of the legal entity, right? Goods and services produced outside the country because GDP is domestic, right? All right. So besides those pitfalls we need to be aware of, so I want to emphasize usually GDP is imputed. What does that mean? It just means usually we don't have a completely account of our real economy. And why? So here's one reason. Okay. In a typical American family, many economic activity happens inside the family, but without proper accounting. Just give you example. Okay, so my son, so he's in high school. And so during the summer times, every week, he is responsible to mow the lawn. Okay, but usually we don't pay him. Not, I mean, explicitly, we don't pay him. But actually, so he's producing goods and service, right? Because actually, usually, so like my neighbors, so they hire a mower to mow that. Usually they charge like $50. So that means literally my son every week, actually, as a matter of fact, so our lawn is better than my neighbors. So because, but that just means that my son is doing a good job to take care of the lawn. So it means the value of service you provide is more than $50, right? But these, even those we pay, just there are two scenarios. Even scenario number one, we pay our son cash, right? Or so we don't pay him cash, but as a reward, we offer him something else, right? But in either case, for the entire summer, he's probably going to provide like $1,000 of value, but this is not going to show up in Bureau of Economics. So the BA, Bureau of Economic Analysis, like the agency who is responsible to measuring the GDP. Does that make sense? This is number one, right? So in either case, if the cash or you don't pay my son, so in either case, doesn't enter the accounting system of the United States, right? This is number one. And number two, the other big part is, oh, by the way, so this is inside a family, right? Okay, so this is just plenty of example, right? So not only my son help us to do these chores, so myself, I just do lots of chores myself. Like say, for example, so I fix some part of the house, right? Usually we need to hire someone, but if I can fix them myself, I save the money, right? But it's not accounted. The other part of our life that are imputed is because of the informal income or underground income or illegal transaction, right? So I'm asking a question for you to think about. First, we understand, so our life is imputed in the sense of measuring GDP, meaning usually, so the GDP underestimate the actual economic activity, right? Okay. Now my question for you to think about is, so if you compare two countries, a rich country or advanced economy like US versus a poor country like African country, to what extent or which country is more imputed than other and why? So these questions for you to understand, to think about, and we can discuss in next class, right? Okay, thank you so much for your attention.